Now, usually, I try to make videos that inspire you to travel or chase your dreams, and I'd much rather you watch those. But I do realize that a lot of times chasing your dreams end up becoming a business. So I thought I'd lend a helping hand, or two.
Receivables turnover ratio. What is it concerned with? Simple. How good are we at collecting cash? Okay, if we have a good and our customers have money, we spoke about accounts receivable and we said sometimes they may not actually have the money, but they still have the intent to buy. So what we'll take in a way is an IOU. So we'll give them the good and they'll give us an IOU, which is usually a credit card swipe, or we just sell on credit to people we really trust. Okay, let's just keep it simple and say we sell on credit. Instead of actually collecting cash, we collect a promise that they'll pay. Those are accounts receivable. The good is no longer our property. We've transferred that, but we didn't actually collect cash. So we want to understand how good are we as a company at collecting cash? Because think of your life right now. Would you rather have $10,000 in your bank account, or would you rather have a bunch of your family members owe you $10,000? I'm going to answer for you because you may want to be clever here. And let's just pretend that you'd rather actually have the cash. This is what calculates that. So what we're going to look at is the money. Just say all the cash we should have collected, okay? Because that's what your sales is going to include. Money that you're owed and money that you actually were able to collect, ready money you're able to collect. So that will cover a stretch of time. Why? Because it's going to come from our income statement. And the income statement is going to start from a certain point and end at a certain point, and we're going to find the information we need, which is our accounts receivable on the balance sheet. So that will be our beginning balance and our end balance. Okay, so on the balance sheet, we're going to be looking for the accounts receivable at the beginning of the period and the end of the period. A lot of accountants, the very good ones, will actually have an accounts receivable balance statement. So they'll actually be tracking this because they also want to know how good are you at collecting cash. So how does this ratio work? We're going to have an example now. So let's say in the beginning, we were owed, before we even started business for this period, we were owed $10,000. By the end of the period, we were owed $30,000. How much did we actually sell? We'll say $100,000 worth of stuff. So we should have $100,000 of cash in our account, but we're not always going to, because we are sometimes going to sell on credit. We just want to know how good are we at collecting cash. Okay, so we would divide and we would look at the beginning of a period, because remember, the balance sheet tells you everything you need to know about a company at a specific period, a specific point in time. And over that period is the income statement. So let me say it again. The balance sheet will tell you information about a specific point in time, and then the income statement will go over a period. All right? And I apologize for misspeaking there. It might have confused some people. So we'll say in the beginning it was 10,000 plus 30,000. Okay. Divided by 2, because we need to find the average, and I'll write that down. The average accounts receivable. Okay, and this is going to be 100,000 divided by, I don't know if I should, I'm going to write it out. So it's going to be 40,000 divided by 2. That's really just 20,000. So it's 100,000 divided by 20,000. And we have a receivables turnover here of 5. All right. So you want to know where you stand. Are you getting better from period to period actually collecting cash? A bank is going to want to know, hey, look, he sells a bunch of stuff, but I mean, should we take the risk of still lending him money? Because if he's just mostly collecting IOUs, people change their minds. That's something that happens in business. They get very excited when they collect a good from you. They tell all their friends, they say, oh, look at my cool new gadget. But after they use it for a while, after 30 days, it gets boring to them and they go, oh, I still owe this guy money for it. I don't think I'm going to pay him. Okay, so you want to get very efficient at collecting cash, because before people change their minds about your product, they've already used it. You're not going to take it back from them. You need to have the cash to be compensated for what it is that you've transferred over to them. So let's see what happens in another example here. Same amount of sales, But we'll say instead of the ending balance being 30,000 for accounts receivable, we'll say we're able to collect cash. Everyone that owed us money, we were knocking on their doors, whatever we had to do, and we collected the cash for it. So no one owes us anything. All right, that's the next example we're going to look at. I just want you to see that the higher the receivables turnover, the better we are at collecting cash. Okay, so this really quickly, okay, we're going to do the average again. It's going to be 10,000 plus this time 5,000, the new ending balance for accounts receivable. Well, 0,000. It's going to be 0 for the new example. I was getting ahead of myself there. Divided by 2. Okay, so you'll see why I said 5,000. That's pretty cool. I'm usually really bad at math. I guess my mind was jumping ahead there. But okay, so it's 5,000. All right, because that's 10,000 divided by 2. And what is our new accounts receivable turnover? Okay, so I didn't cancel this last 0. Let's just get it all over with without talking. So our new accounts receivable is 20. Our new accounts receivable turnover is 20. Okay? When we collect all the money that's owed to us, we do the average from the beginning to the end, and we take the sales and we say, all right, all the money that I should have been paid, everything together, everything I should have been paid and everything I actually was able to collect, divided by the average of what I'm owed at the beginning and the end of the period. And we just see what that number turns out to. And the higher the turnover ratio, the better. That means we are very good at collecting money that we're owed. And that's it, guys.
Thank you so much for watching. Turning a dream into a reality usually ends up becoming your business. That is why we have the Helping Hands videos. Subscribe, like, and feel free to leave a comment below. Don't forget to follow us on Twitter and Instagram. Fans of Kindness, our Facebook page, is also waiting for you. See you in the next video. Until then, be your best and never stop learning.